Well, one fund that has been delivering fantastic returns for investors has been the Coronation Africa Frontiers portfolio, which in the year to the end of May delivered a return of 44% in US dollars. And since inception, the fund has delivered annualized returns of 18%. Joint portfolio manager Peter Leger joins us in studio to tell us how the portfolio has been constructed. And let's start right there with construction of the Africa Frontiers portfolio.
Thanks very much, Bronwyn. Yeah, I think, by way of putting a portfolio together, it's Africa for us has been no different to any of the other Coronation portfolios. And what one then finds as an ultimate result is purely stock picking and where we see good value in stocks. So, we've really resisted a macro view, which is very tempting in Africa, given that it tends to become a story of growth and consumer and demographics. For us, it's been, what are the stocks that we like? Where's there a large margin of safety? And ultimately, that's defined the portfolio that we've resulted in. And there's quite a mix in there. It does have a large consumer focus, and that's a function of that we tend to like consumer stocks. They're great cash generators. They're very defensive businesses. They pay good dividends. Overall, we just think they're very honest businesses that you can trust the numbers to a high degree.
But just pausing there for a moment, Peter, pausing there,
yes.
you have made the comment in an earlier conversation with Warren that the consumer story is overdone.
Well, I mean, and again, it's not unique to Africa, but one of the themes that we've seen in South Africa, we've seen in emerging markets, investors have started paying up and very high ratings for consumer stocks. So we've been quite selective in terms of the positions that we own. And if you look at what we own, we've got very chunky positions in the consumer stocks that we do own. So it's not made up by a large dispersion. So I would agree, there's stocks, Nestle in Nigeria, it's trading in the 30s, Unilever Nigeria in the 20s, late 20s. And these businesses haven't all been producing, Nestle I think has been producing very good results, but it's not been across the board and consistent. So we've been more hesitant in terms of owning some of those positions, but the stocks that we still think are very, very undervalued in the consumer space are brewers. And that's on a multi-year modelling forecast in terms of doing the fair value on that. Brewers in Africa have multi-year growth still ahead of them, and the profits that they're making don't reflect a normalized environment. They've been investing for growth. Margins are much lower than what you find elsewhere, and they are incredibly strong businesses that to unseat them, and in terms of the defensiveness and the protection around, or the moat around the business, it's very strong, very high, and we think the ratings there have still some way to go before we would be concerned about that.
Peter, just to come in here, you mentioned that the consumer story has been overdone, but you face a unique challenge in Africa with the public markets that lack liquidity. Even if you thought the shares were overvalued, it's very hard for you sometimes to get out and then to get back in when they've dropped again. So how do you play that from a portfolio construction perspective with some of these sort of stocks that you obviously like, but that are perhaps trading at a premium to what you think is the fair value?
So, I mean, ultimately, one has to be disciplined around valuation, because that's what this is about. It's not going to be a relative investment story, and you're absolutely right in terms of liquidity, where if a stock is stretched in terms of valuation, one has to think about the consequences of saying goodbye and not being able to invest into that stock again. But ultimately, if you have your fair value in mind and you have a high conviction around what that fair value is, and you move through that, the right thing to do at that point is to sell the position, because ultimately we're in the game for putting a portfolio together for our investors where there's a margin of safety and it reflects value, and we're not here to hold positions which we think are overvalued.
Peter, just to come into that, you obviously sent us your top 5 holdings, and 2 of those are companies based in Zimbabwe, obviously a country that's going through an election cycle this year. And it seems to be another unique factor around public markets and African economies is that there seems to be a slowdown ahead of elections, just as people are cautious and waiting to see the outcome of those elections. So just talk us through your holdings in these 2 companies, Econet and Delta, and also how you kind of manage the election cycle with the country and specifically Zimbabwe.
So we've been heavily invested in Zimbabwe for some time now. In the middle of 2011, we built a large position. There was a lot of negative news flow around indigenization, and generally there weren't many buyers around. So we've taken a large position, which, yeah, I mean, it was purely a function of value, where stocks were trading at extremely low multiples, and we just couldn't resist buying. In fact, we moved our prudential limit in terms of what we could have by way of exposure to Zimbabwe because it was so attractive. It's a great example where, despite the macro concerns and the noise around politics, it's been a phenomenal market to be in. I mean, over a year, the market's up over 110%. It's the best MSCI frontier market in the world. And that's despite an election that's looming where it's very difficult to form a view as to how that's going to play out. To reiterate again, we're not taking a strong macro view here. Whether the election goes well for business or not, that's not what our position is predicated on. We think whatever happens, businesses will carry on as usual, and they are incredibly resilient. If you look at what they've come through and how well they've done, we've got no doubt that that'll continue. And the returns that we've seen in Zimbabwe have not been driven to a large extent by a re-rating. The companies there have in fact produced very, very good earnings, and we think that can continue to carry on going forward. Ratings are still very attractive. I mean, if you look at the top 40 stocks there, a large number of them are still on multiples below 10, trading below price to book. So this is a market that's still showing huge amounts of distress in terms of valuation. Yet the management teams have really shown a very strong ability in terms of what they've managed through. So, going forward, whatever the election brings, we would hold our position.
Would you up your position, given that distressed valuation environment? How high is your level of conviction? Are you going to up your allocations?
So at the moment, the portfolio has around 18% in Zimbabwe. For us, we've set a prudential limit of 20, so it shows you how high our conviction is. I mean, previously it was 15 in terms of a prudential limit. Where appropriate, and I think there are some excellent companies which we would like to hold more of, and we would look to do that. But overall, we've got a very healthy position which would be hard to replicate, and we think that we'll still be there for a while.
Peter, your biggest position from a geographic perspective is Nigeria, and I assume that again talks to the consumer story, given the 160 million plus consumers in that environment.
Yeah, so again, on Nigeria, we haven't taken a strong demographic or macro approach. It's purely where we found businesses that we rate highly, and historically, for instance, we've not held a lot of the banks in Nigeria. We've had a lot of concerns around the banks, and over the long term, those have proved valid. But where we do own positions in the banks, they're very specific, very focused. We own a lot of Stanbic IBTC, for example, which is a bit of an outlier. Not many other funds do hold any of that. And what we're seeing are businesses that have moved into Nigeria that are slowly building a franchise, which we think will do a phenomenal job of building businesses for the long term and do extremely well, and we're very happy to be there.
Peter, obviously you've had a great run of the last year with that return in US dollars, and also I just looked at the performance history of the fund, obviously that 18% since inception, but it's been a bit of a choppy ride. Have you seen, I guess what we should do is really ask you, what should investors be expecting if they were to give you funds at this point?
Well, I think it's valid. Yeah, it's valid. It's a very good question, and it's for any point, be it now or 12 months ago. So any investor who comes in, the first thing we'll say is that we're not going to provide a forecast for the next 6 to 12 months, because returns in these markets will purely be a function of short-term risk appetite, both globally and locally. And another Cyprus event, by way of example, will send us tumbling down again. But over the medium to long term, so 3 to 5 years, we think the businesses that we own in the portfolio are still appropriately rated for excellent returns for investors. If I look at our top 10 positions, we've got a number of stocks in there that are 6 to 7 times forward earnings. Dividend yields range between 4 to 8%. It's a great collection of companies to be able to own in global markets, which there are very few opportunities like that.
Peter,